If you are a domestic automaker right now, you are operating against a 5 to 10-year ticking clock. Today's analysis takes a stack of corporate financial reports, second quarter earnings data, and global trade policy to answer one structural question.
Right. Can a 100% tariff actually save Detroit? Or is it just buying time?
Let us look directly at the data. Ford's chief executive recently delivered a highly specific timeline to employees. Management's assessment is that Chinese automakers could enter the United States within the next 5 to 10 years, likely toward the later end of that window.
And for now, the defensive wall looks exceptionally high.
It does. Chinese electric vehicles currently face tariffs of about 100%. Furthermore, Washington has instituted connected vehicle rules that establish strict digital perimeters. These regulations restrict covered Chinese software beginning with model year 2027.
And they restrict covered connectivity hardware beginning with model year 2030.
Right. If you just read the regulatory filings, the Detroit automotive sector appears heavily protected.
We'll look at the margin data and the underlying mechanics first. A tariff functions as a pricing mechanism at the border. It makes a rival's vehicle artificially more expensive for the end consumer. But what it absolutely cannot do is alter the structural economics of domestic manufacturing.
Right. A border tax does not lower Ford's fundamental battery costs.
No, it doesn't shorten their engineering cycle, it doesn't simplify the factory floor, nor does it inherently make an affordable American electric vehicle profitable to build. Protection, in this context, is valuable only as a measure of time.
And if you do not use that time to restructure your cost base, the tariff is just a temporary dam holding back an ocean.
Ford management appears to understand that distinction, though the transition is financially violent.
When you look at their current balance sheet, you see exactly where the capital is generated. The company's internal combustion engine, truck, and commercial businesses remain highly powerful sources of cash.
Just looking at the second quarter financial reality.
Yes, Ford generated $2.5 billion of adjusted operating profit. On the strength of those specific legacy divisions, they raised their full-year outlook to between $10 billion and $11 billion. It is a highly profitable present.
But contrast that profitable present with the financial reality of Ford Model E, their dedicated electric vehicle division. In that exact same second quarter, Model E recorded a loss of $919 million.
And looking at the full calendar year, Ford expects the Model E unit to lose roughly $4 billion.
Right, and that figure includes their ongoing capital expenditures for an affordable EV platform and their energy storage business. But as an observer, you have to acknowledge the tension here. The legacy business is actively financing an unfinished, heavily unprofitable future.
Subscribe to the Unlayered Global if you value analysis that follows trade policy into factory cost, household affordability, and industrial power.
Returning to the data, the prevailing headlines suggest that Chinese automakers are coming to America. The much harder analytical question for market participants is defining what coming will actually mean in practice.
Because the initial entry is not going to look like a BYD dealership opening up on a corner in Michigan.
So if they are not building a massive retail footprint in the Midwest tomorrow, how are they probing the perimeter?
Well, we can look at the Canadian market test. The Canadian government established an initial annual quota of 49,000 Chinese electric vehicles, subject to a 6.1% tariff.
That limited volume functions strategically. It provides Chinese companies with a nearby North American test market to gather data on pricing dynamics, service network requirements, and direct consumer response, without triggering massive retaliation.
But Mexico represents a data point that is much further along in the cycle. During the first half of 2026, Chinese brands successfully capture 17% of the new vehicle market in Mexico.
That is up from 14% a year earlier.
Even more striking, their total sales volume rose almost 30%. And that occurred despite a 50% tariff on vehicle imports from China and several other Asian countries.
I mean, we must temper that Mexican data point with some analytical skepticism. If you look at the immediate aftermath of that tariff implementation, direct imports of Chinese brand vehicles fell sharply.
Right, and it is also clear from the inventory data that these companies aggressively built up their stock before the 50% tariff took effect.
However, the sustained sales increase demonstrates a critical underlying metric. The brands retain their consumer demand. The Mexican data doesn't prove that tariffs fail entirely, but it highlights that consumer demand for lower-priced, high-technology vehicles exists independent of the border friction.
It is also critical to clarify for you that Mexico is not an automatic backdoor into the United States market. You cannot just ship a car to Monterey and drive it across the border tariff-free.
Right. The United States-Mexico-Canada Agreement, or USMCA, establishes high barriers to entry.
Under the USMCA, passenger vehicles and light trucks generally require 75% North American regional value content. This means 3/4 of the vehicle's value, from raw materials to final assembly, must originate within the 3 countries to receive preferential trade treatment.
So to bypass U.S. tariffs, a Chinese company would require substantial North American localization.
Simple final assembly, just bolting the doors onto an imported chassis near the Texas border, would not meet the threshold.
That is accurate based on current trade rules. But localizing supply chains fundamentally turns an import strategy into a long-term industrial strategy.
Right. If a competitor takes the time to establish local battery cell production, stamping facilities, software integration, supplier networks, and full assembly operations in Mexico, they are no longer just an importer. They become an embedded North American manufacturer.
The route into the U.S. market may also run directly through partnerships, circumventing the border entirely. Consider Ford's strategy at their Valencia plant in Spain.
Yes, Ford has agreed to create a manufacturing venture with Geely, a major Chinese automaker. We are seeing a scenario where Ford will compete directly with Chinese companies in certain global markets while simultaneously sharing plant economics with one in Europe. It is proof that competition crosses borders via shared industrial infrastructure long before a brand nameplate does.
To understand why Detroit is willing to form these partnerships, you have to look objectively at the Chinese production benchmark. The International Energy Agency has provided a stark estimate regarding the cost gap.
Producing a battery electric car in China costs more than 30% less than producing one in advanced Western economies.
And roughly 1/3 of that 30% cost gap comes directly from the battery itself.
Let me ensure we are fully framing the scale of this. A 30% cost advantage on a $40,000 vehicle is a $12,000 difference in production cost.
The scale of that dominance is evident in the 2025 global production statistics.
In 2025, China accounted for 70% of global electric vehicle production. They accounted for more than 80% of global battery cell production.
And moving upstream into the raw supply chain, China produced roughly 85% of cathode active material and more than 90% of anode active material used in EV batteries.
Just to clarify the mechanics, think of the cathode and anode as the positive and negative lungs of the battery. China is not just assembling the final car, they're controlling the very air the battery breathes.
That structural difference is where the cost advantage is born. Chinese automakers tightly link their systems. They maintain direct internal integration between vehicle engineering, the battery supply, the electronics, the software development, and the final manufacturing.
While Western companies generally rely on a decentralized approach, breaking the car down into components and distributing them across supplier tiers, Tier 1, Tier 2, Tier 3.
And that decentralized approach spreads systemic risk across multiple corporate balance sheets, which is a traditional Wall Street risk management strategy. But it also adds layers of integration work.
It mandates complex component testing across different systems.
And critically, it builds supplier profit margins into every single step of the process.
Right. If every supplier in the chain requires a 7% margin, those margins stack up rapidly before the vehicle ever reaches the final assembly line.
Precisely. And this highlights the greenhouse risk facing Detroit. Because of the current margin pressure, domestic manufacturers have rationally concentrated their profit pools in full-size pickups and large SUVs.
But that capital allocation strategy leaves them entirely without low-priced product lines through which their engineering teams can learn and enforce strict cost discipline.
The protected U.S. market is essentially a greenhouse. Inside the glass, it is warm and safe. Large trucks remain highly profitable, but the companies get soft.
While outside the glass, in the harsh winter of the global market, Chinese automakers continue to build brutal cost discipline and massive scale across Europe, Latin America, and Southeast Asia.
The protected market looks healthy on a quarterly earnings report, but the global benchmark keeps moving further away.
Ford's direct response to this shifting benchmark is its universal electric vehicle platform. To combat the greenhouse effect, the company has committed a $5 billion investment distributed across its Louisville operations and its Michigan battery plant.
The primary target for this capital expenditure is a mid-size, 4-door electric pickup truck. The stated consumer price target is around $30,000, scheduled for 2027.
The manufacturing targets provided by Ford demonstrate the sheer scale of the required engineering overhaul. They are targeting 20% fewer parts. They're aiming for 25% fewer fasteners.
The factory footprint targets 40% fewer assembly workstations, and they are targeting a 15% improvement in net assembly time.
As an analyst, you have to push back dryly on those figures. Cutting assembly workstations by 40% is not a trim, that is an amputation.
I mean, those are internal company targets, not proven mass production economics. A $30,000 price point must survive the realities of battery yield rates.
It must survive domestic labor agreements, warranty expenses, dealer economic margins, and baseline consumer financing rates. Execution risk here is immense.
The capital allocation contradiction here is, it's notable. Ford possesses the cash flow required to attempt this multi-billion-dollar redesign entirely because of their legacy vehicles.
Looking again at the second quarter, Ford Blue, their traditional combustion division, earned approximately $1.1 billion in operating profit.
And Ford Pro, the commercial division, earned roughly $1.7 billion. Those specific profits provide the cash to attempt the redesign.
They provide the cash, but those very profits create a fiduciary reason to delay. If domestic buyers continue to select highly profitable gasoline trucks and hybrid models, Ford can produce very strong quarterly earnings without having to solve the affordable EV equation right now.
Expanding hybrid production alongside electric vehicles spreads your engineering capital and tooling across multiple systems. Flexibility certainly has strategic value. Duplication, however, carries immense operational cost.
The profits that fund the reinvention also suppress the urgency required to execute it.
Ford's strategy regarding its Michigan battery facility perfectly illustrates this layered complexity. Blue Oval Battery Park, Michigan, is currently being prepared to produce lithium iron phosphate, or LFP, cells specifically for Ford's affordable EVs.
Ford fully owns and operates the physical plant. However, the manufacturing arrangement utilizes LFP cell knowledge and technical services provided directly by CATL, which is the undisputed Chinese battery market leader.
This is a critical data point. It is essentially a battery Trojan horse. It brings Chinese industrial capability and high-yield manufacturing knowledge directly into the American industrial base without a single Chinese car crossing the border.
Ford gets the cost structure, CATL gets the licensing revenue.
But Washington views this through a different lens. They look at the vehicle not just as bent metal, but as a digital entity.
This shifts the focus to the connected vehicle rules restricting covered Chinese software beginning with model year 2027 and connectivity hardware beginning with model year 2030.
Washington views automotive entry primarily as a national security issue, not just a price issue, because modern vehicles are essentially rolling data centers.
A North American factory footprint does not answer the security questions. Who wrote the underlying software architecture? Through which servers does the telemetry data move?
The Lincoln Nautilus serves as the perfect paradox for this digital reality. Ford currently imports the Lincoln Nautilus. The physical vehicle is assembled entirely in China.
However, Ford maintains that the vehicle's software is developed in the United States, even though it is physically installed during the Chinese production process.
The automotive nationality is now deeply layered. You have an American badge, Chinese physical assembly, and American software architecture.
The connected vehicle rules are designed to defend the control layer, the data, and the software.
And the tariffs are designed to defend the physical product border. But here's a structural reality. Neither a tariff nor a software restriction reduces the total number of parts required to assemble Ford's next-generation truck.
The underlying cost problem remains untouched by the regulation.
Looking forward, if you are an investor or a market observer, there are two diverging structural outcomes that matter.
In the first outcome, Detroit utilizes this protected period well. Ford hits the $30,000 pickup target, the Michigan LFP facility scales with acceptable yield, and the border tariff functions exactly as it is designed, as temporary industrial scaffolding.
Consumers eventually get a credible, lower-priced vehicle, and American plants gain necessary volume.
In the second outcome, Detroit stays highly profitable at home, while Chinese firms aggressively build scale everywhere else. The U.S. risks becoming a profitable but isolated automotive island.
Detroit remains globally dominant in full-size pickups, but structurally weak in the exact vehicle categories that set the global technological and production benchmark.
To track which outcome prevails, you need to monitor 4 specific metrics sequentially.
First, you must monitor the final starting price of the electric pickup when it actually reaches the dealer network.
Second, you must track the trajectory of the Model E losses quarter by quarter. Are they shrinking as scale improves?
Third, you must evaluate the actual contribution margin of the new platform.
And fourth, You must measure the exact share of critical technology that Ford can successfully localize without losing its cost competitiveness against the global benchmark.
That final localization metric is key.
Tell us which defense matters most for Detroit. Permanent trade barriers, lower manufacturing cost, or selective partnerships that localize foreign technology. And subscribe to the Unlayered Global for more analysis of the money, factories, and policy beneath the automotive headline.
Ford may be right that direct entry is 5 to 10 years away, but the industrial contest is already here. Detroit will not win it at the border. It will win or lose it in the cost of the next vehicle.